Welcome to Talk Tickers. Today, we're digging into Pacific Biosciences. Now, their latest earnings report was a real head-scratcher. You had a solid beat on the bottom line, but a miss on revenue that, well, it sent investors scrambling. So let's unpack exactly why that happened.
Okay, so this slide really lays out the basic conflict. On one side, you have a pretty decent earnings beat. PacBio lost 12 cents per share, which was way better than the 16 cents Wall Street was bracing for. But, and this is a big but, on the other side, you've got the revenue miss. They brought in $38.4 million, falling short of the nearly $40 million target. And in the world of high-growth biotech, that top-line number is what everyone's watching.
And the market's reaction? It was fast, and it was brutal. Despite that earnings beat, the trading that followed was, to put it mildly, a significant negative reaction. So the question is, what on earth did investors see that made them completely ignore that positive surprise on the bottom line? To get that, we've got to look under the hood.
Right, so what's really happening at PacBio isn't just about one quarter's numbers. It's a much bigger story, a story of a major strategic pivot. The company is in the middle of shifting its whole business model away from selling big, expensive machines to building a steady, recurring revenue stream from consumables. And you can see that pivot happening right here on this chart. For the first time, consumables, think of them as the ink for the printer, make up more than half of their total revenue. We're talking a record $21.3 million this quarter alone. This right here is the absolute heart of the bull case for the company.
And this chart just lays it out so clearly. PacBio is basically running a two-speed business right now. You see that sharp 33% drop in instrument sales, and yeah, that's what spooked everybody. But look right next to it. You've got healthy double-digit growth in both consumables and services. This is the transition in action.
So why does this pivot matter so much? Well, it has a direct and very positive impact on the financials. See, consumables have much better margins than the big instruments. So that shift, combined with some really disciplined cost-cutting, pushed their non-GAAP gross margins up by an incredible 900 basis points. They hit 42%. That is a huge leap in profitability.
So, let's move on. Because all of this sets the stage for two very different stories. You have management's really optimistic narrative about this successful transition, and then you have the market, which is looking at all this with a whole lot of skepticism about the risks.
On the earnings call, management was, rightly focused on all the good stuff. They hammered home the record consumables, the expanding margins, and some really big wins on the clinical side in China. They also talked up their new SPRQ-Nx chemistry, which is basically tech that's going to make genome sequencing cheaper. And they even narrowed their full-year guidance, which is usually a sign of confidence.
But the market just wasn't buying it. This timeline tells the whole story. Right after the numbers came out, the stock actually jumped in after-hours trading. But as people started to really dig into the details on the conference call, that optimism just evaporated. The stock ended up closing down over 7% the next day on massive volume.
So what was in those details, right? What was it that turned that initial pop into such a big drop? It's because the market wasn't just looking at the past, it was looking for clues about the future. And here's what they found. That 33% drop in instrument revenue was a huge red flag, because selling those machines is how you get future consumable sales. They only shipped 13 of their big Revio systems, way down from 22 a year ago. Management blamed some delays in Europe, and even admitted to cutting prices to win some deals. To an investor, all of that screams soft demand and execution risk, especially when the company is still burning through cash.
So this brings us to our take here at Talk Tickers. How do we balance this? On one hand, you have clear progress on a really important strategic shift. On the other, you have some very real, very near-term risks.
Okay, so management is guiding for a strong fourth quarter, with about 10% sequential growth. They think instrument shipments will bounce back. Now, we think that's possible, but it is definitely risky. Those delays and pricing pressures could easily spill over. So our forecast is that they'll probably hit the low end of their full-year guidance. The good news is that margin story looks totally sustainable, as long as that mix keeps shifting to consumables.
So when you put it all together, our rating on PacBio is market perform. The bull case is legit. This pivot to a higher margin recurring revenue business is happening, and it's making the company healthier. But the bear case is just as real. The weakness in instrument sales creates a ton of risk and makes you question how fast this is all really happening. In our view, the current stock price pretty fairly balances those two forces.
So finally, let's talk about the trade. With the market perform rating, how might someone actually approach the stock? Here's one plausible idea.
And of course, we have to say this, we're analysts, not your financial advisors. This is for informational purposes only, so please don't take this as advice.
The idea here is to become what's called a premium collector by selling cash-secured puts. The thinking is that even if the stock doesn't rally, there's probably a floor under it because of their strong consumables growth and their cash pile. So by selling a put below the recent lows, say at $1.50, you're making a very specific bet. If the stock stays above that price, you just keep the premium you collected as income. Simple. If it drops below, you have to buy the shares, but you get them at a net cost that you were comfortable with from the start. It's basically a way to get paid to wait for the story to get a little clearer.
So that's our take on PacBio's quarter. It's a really fascinating story of a company making real progress, but running headfirst into market skepticism. The road ahead is all about execution. And as always, just a final reminder, this analysis is for informational purposes only and is not financial advice.